Hey, I'm Davey with Robert L. Webb and Associates, and with me today remotely is our founder and CEO, Mr. Bob Webb, and we're going to talk to you for a minute about cash flow. This is something that we've seen multiple clients. There's rarely a business that at some point in their operating history is not affected by cash flow challenges. And Bob, I know you've got a set of bullet points that we're going to go through here, and kind of talks about just little small changes to maybe existing practices that companies can make to help add some cash to their balance sheet.
No, that's exactly right. Almost every candidate and client that we go to has, as you said, cash flow challenges at some point. So we try to give everybody some helpful advice, and other clients that need it urgently, we work with them a little bit closer on that. But sure, we'll be glad to go through some that maybe anybody can pick up and use in their daily business.
All right.
Okay, Bob. So the first thing that we've got up here is accounts receivable (AR) practices. Now, I mean that seems pretty elementary in nature. I mean, you need to, make sure you send the invoices on time and accurately, obviously, to get paid like you want to. But what are some of the things that you've seen on this that can delay that process?
Sure. One thing is accuracy. A lot of our clients will fail to put the correct purchase order number or the project number. They won't have the right quote number that it went with originally. The scope will be described wrong. It'll go to the wrong person, or it'll go to some general info at client.com, and that's not the address. It has to go to a specific person, or maybe even two people at the email address. Some customers are still sending paper invoices when they need to be sending email invoices. So all those kinds of combinations we group under the term of not an accurate invoice according to the customer terms. Uh, Timing is another one. We believe that after the completion of a milestone or a project or a product or a service, whatever the frequency is, it needs to go out within 24 hours. Oftentimes at the customer site, if invoices are delayed 2 or 3 weeks and then receiving them, they don't get the proper attention. They're dealing with what comes in every day. You sort of get pushed to the side. But if you're very timely and very accurate, there's a 98% chance you're going to get paid on time. And we also advocate having a relationship with a person who's paying those invoices with the client. So even though it's hard in larger companies, most of the time there's a team, a small team of 2 or 3 that are assigned to your industry, your product, your geography. So trying to get to know them and just simply saying, what can I do to avoid problems? What kind of problems do you see with my co-vendors, my competitors that cause them to have delays? I want to avoid that. So a little bit of a personal relationship goes a long way in helping pre-resolve issues.
Well, when you're talking about those national retailers, big box stores, a lot of our clients are surprised to find out when they're supplying them that those big guys have people on their team that their only job is to look for those errors and omissions on the invoices.
No, that's exactly right. Normally, those stores, they sort of beat you up on price. Your margins are low, your returns are high, the allowances are high. So most of our customers are operating on a thin margin anyway. But that big customer, they're having millions and millions of dollars of cash flow in and out every day. So if they can put off a few $1 million spread over 200 vendors a day, that's significant cash flow advantage to them. And you're right, they have people who work specifically on delaying payments to improve their cash flow. Timing is everything with them. They've already got the margin. They got the margin where they want it. Now they need the cash flow timing with it as well. So you're an army of one yourself when you're up against those guys. So you just have to understand how the game's played and meet their terms that you've agreed to, and then you'll get paid properly.
Well, let's talk a minute about inventory. We've seen a lot of this clients that either they have too much inventory or they don't have enough inventory, but in both situations, that's got a direct effect on your cash flow.
Absolutely. And probably 90% of the time when there's an inventory problem, it's too much inventory. It's rare to see someone, manufacturer, distributor, wholesaler, with too little inventory because everybody's geared to not ever want to miss a sale. But sometimes missing a sale actually helps create demand for your product. What people don't look at typically is the fact that inventory takes up space, it has to be moved, it has to be insured, it gets damaged, it goes obsolete, particularly in a tech field. There's all kinds of issues with inventory that cause it to have to be written off. We tend to forget about that because write-offs generally occur maybe once a year during an audit or during a physical inventory. But actually, things are going wrong with inventory every day. We just don't recognize it except maybe once or twice a year. So having too much inventory really has hurt and put a severe cash flow problem with many of the clients that we deal with, sort of in the $20 to $50 million revenue range. So we advocate trying to have the optimum inventory, not the least, not the most, but we have some engineering studies and mathematical models that we help clients with to determine what the optimum inventory is, and their write-offs are fewer, their margins become higher, and their cash flow becomes higher. So managing inventory is a critical component to those businesses' success that have to maintain an inventory.
You know, one thing with inventory is it seems like we've seen multiple clients where inventory is more of an emotional decision on the choice whether to hold or sell than it is a rational decision. You know, you buy this inventory and it's perceivably, you know, especially depending on what it is, a lot of inventory doesn't hold the value for months and months on end. And then you end up sitting it and riding it to the bottom. It just becomes a race to the bottom.
Absolutely. Nobody ever purchased inventory they didn't think they were going to sell. And so part of it is our human nature. We don't want to admit we made a mistake. But as soon as you say, I made a mistake with this, one, let's go back to the root cause, find out why we made the mistake so we can correct our process so we won't make it again. But then the other important part is we recognize we make a mistake. Now let's turn that to cash as quickly as we can. Let's find there's a number of outlets that buy inventory. Sometimes there's alternative uses, but taking that inventory that you've paid for or that you've borrowed money on to pay for it, turning it back to cash is, once it doesn't serve its primary purpose, is usually the best alternative. And we've helped many clients go through their obsolete, slow moving, excess inventory, turn that to cash, reinvest it back into the business, into new products, new services, better inventory management systems, and then they have a much better track record going forward.
Can you give me a specific example? I can think of a couple of clients that you've worked with in the past where out of a whole host of things that you were working on, inventory was the absolute key, and just selling off or changing some inventory practices is what kept that business afloat and moved them from just surviving possibly to really growing and thriving going forward.
No, absolutely. We worked with a company that was a $50 million manufacturer of specific paper products that were sold seasonally in a back to school environment. Well, they would have to borrow the money to build the inventory over several months. Then the selling season was about 6 or 8 weeks in the summer prior to students going back to school. Well, I never realized that these kind of paper products, notebooks, were fashion items, that they've got a superhero that's the feature this year, or they've got, you know, some rock group that's a feature next year. And once that season passes, those items go to 10 cents on the dollar. So they were overbuilding inventory, hoping they would sell it, but they lost most of their margin because they had to dispose of it at the end of the season. It had no value. So we said it's better to miss a few sales in order that we don't have these huge write-offs at the end of the year. So we were able to help them optimize their inventory, optimize their production process, and then they were able to pay off their ABL loan at the end of the season completely, which they hadn't done in several years. Plus, they increased their cash flow plus they increased their margin. So that was really an inventory business. That was the core of that business. So managing that inventory and the production that went with it, that was the key to their success.
I see. Now, deposits and life insurance. This is not an area. When I think cash flow, Bob, I don't think about life insurance. And what type of deposits are you talking about?
Well, a lot of companies, they'll set up a new operation or maybe expand an existing operation. They've got deposits with utility companies, landlords,
Mm,
and oftentimes the contract terms say that after 1 year or 2 years or a successful history, those deposits are able to be returned in whole or part. So sometimes, you see companies have $5,000 and $10,000 deposits with various utility companies. Um, and landlords. So oftentimes we're able to get some of that back. A lot of companies on an owner, they'll have a life insurance policy that's maybe not needed anymore. We found one buried at one company, $400,000 worth of life insurance that was unneeded, that had built up significant cash flow or cash value. We were able to liquidate that policy, reinvest those proceeds into the business to help them stabilize and then grow their business. So yeah, there's some hidden things on the balance sheet that you just don't think about every day. It's not in the normal flow, but they're out there. So we sort of scour that balance sheet, and we interview the principals. And sometimes people don't follow GAAP completely. They may not have it on the balance sheet, but it really is an asset. So we do it through interviews, and we do it through scouring the balance sheet to find these sort of hidden gems that we can turn to cash.
gotcha. Okay. Moving on, land and building. This is something that comes up time and time again, that buy versus lease scenario, or if they already own the building. We've had multiple engagements where our recommendation was to sell the building and then possibly lease it back. Building and land, it can just be a huge sort of influx of cash that's just sitting there if you'll take advantage of it.
That's right. Many people have owned their building and land for years. It's built up significant equity value in the process that they've paid down the note, maybe not completely, but they've paid it down significantly, and the land and building values have increased. So they've won the equity battle two ways. All that's locked up. So oftentimes we'll sell the building and land, lease it back. Sometimes an owner wants to own the building as part of their retirement portfolio.
Sure.
That's fine. We let the owner own the building and lease it back to the company. Businesses don't think they're going to relocate, but many businesses over a number of years, 20, 30, 40 years, actually it's to their advantage to relocate. Sometimes commercial property is hard to sell. It takes a long time to sell certain pieces of commercial property. So we encourage most of our clients, and it depends on the specifics of the situation, but most of our clients, 20 to 50 million in revenue, they're better off leasing a facility, even if the owner wants to own it for their retirement purposes. That's fine. If they don't need that or want that, then leasing it from a third party with some flexibility on terms really is an advantage to the company, because I've seen companies get landlocked in their building. Then they couldn't afford to move. They got to the point they didn't want to go through the hassle, yet their business would grow much faster in another part of town, or even in another town or city, depending on the industry.
Right. You make a good point there. I mean, we've seen several owners that maybe they corporately, the building is owned, and oftentimes it's a better scenario for the owner of that company to own the building personally and then lease that building back to the company, and that can make, like you said, a good retirement or help with an exit strategy as well.
Absolutely. The owner owning the building does give them a lot of flexibility. We have a client we're working with right now. We've just started, and they're going to do a consolidation among dealers. And some own the building, some rent it from a third party, some want to sell their building, some want to combine it into the new entity. So they've got lots of choices of how they do this. Some of them are going to probably take a 50% cash out on their building because they built equity in it. So yes, there can be flexibility. You just have to have the right strategy for what that owner wants to accomplish in the business. But rarely if the business owns the building, it's not as valuable an asset to growing the business profitably as it is maybe for an alternative purpose. And we want every asset in that business to be generating revenue and contribution margin to that business.
Well, let's go ahead and pause here for part one of this, and we'll pick it back up and do part two of our cash flow series.
Sounds great.